The S&P 500 has once again retraced 6,000 points. Is this the beginning of a renewed bull market? We've seen a V-shaped recovery since its lows in early April, or is this a dead cat bounce? We'll find out with the next guest, Gareth Soloway, Chief Market Strategist at Verified Investing, and we'll be going over his outlook on Bitcoin, gold, not just the stock market, but also the bond market and everything in between. Welcome back to the show, Gareth. Always good to see you.
Always good to see you, David. Thanks for having me back.
China and the U.S. are holding trade talks in London today. Donald Trump's top trade officials are meeting their Chinese counterparts in London on Monday for talks aimed at resolving an ongoing trade dispute between the world's two largest economies, according to CNBC and other news sources. Now, Gareth, this is important because every time we have some sort of stability in the news regarding tariffs and trade between China and the U.S., the markets seem to like that news and go on a rip. And that's what we're seeing kind of in the last couple of days. So I wonder if all this volatility that the markets have seen since in April was really just news driven versus something fundamental in the economy versus just a breakdown of the charts that was going to happen anyway. So I'll leave that to the opening question for you. And walk us through what's going on.
Yeah, so I think you're right in that the markets initially got caught flat-footed by the magnitude of Liberation Day and the tariffs, right? So we had a market that was kind of flying high, that there was a Trump put, that he would protect the markets, and then all of a sudden he comes out with these massive, massive tariffs. And the market began to freak out and fell in early April because they started to doubt that Trump put. They said, oh my goodness, maybe he's more into these tariffs and he's not going to care about the stock market and the economy. And then lo and behold, what did we see? We saw the market starting to recognize that, he backed off once the bond market forced him to back off on his general tariffs, except for China, and then also on these Chinese tariffs. And so the Trump put is back on. And my thesis is this, is that the markets can keep grinding higher as long as the economy holds up, right? So whether there's a trade spat or an Elon Musk Trump feud or any of these other things, as long as the economy is holding up well enough, the markets can grind higher. But if that economy goes, that's where things are going to get messy for the markets.
Well, do you think the economy is holding up well right now?
I think the headline numbers, right? So this is the crazy thing about it, right? So we saw this jobs number on Friday, 137,000. Okay, so 137,000, but let's not forget the last 2 months were revised down by 90,000. So let's just say we revise this one down 50,000. Is that a good number? No, it's a mediocre number. And then you look at participation rate, which is coming down. You look at the overall levels of the U6 unemployment, which are creeping up. So there's no doubt that the labor market is weakening, but the markets for now are willing to look at those headline numbers, focusing on that, and buyers, essentially retail. Retail has been driving this market higher, and it looks like that'll continue until we see a crack in the economy.
Well, like you said, the headline numbers may look solid. Actually, initial claims rose to the highest level since October last week. The May numbers were not good, but these are very volatile numbers. It's very noisy data. But on the top line, the unemployment rate is still hovering around 4.2%. The inflation rate has gone down to 2.3% headline CPI. And so the Fed may be looking at these headline numbers and saying, wait a minute, we don't need to cut rates. What do you think? Do you think they'll cut rates soon?
So I do think the Fed will delay rate cuts. Now, I know Trump is pushing for them to cut, but my thesis here is that we will still see a bump up in inflation. Now, a lot of people would say, well, why haven't we seen it yet? Well, remember that before Trump imposed these tariffs, a lot of businesses bought a massive amount of inventory. And when he's rolled back these tariffs initially and given another 90-day window, businesses are buying massive amounts of inventory again. And so what they're doing is they're buying the inventory essentially pre-tariff, and that enables them to keep prices relatively stable, and that's why I think we haven't seen the inflation. But if the tariffs do ultimately end up sticking, then I do think that the inflation will start to show up. The other thing to keep in mind is that while we're seeing inflation in certain things, we're also seeing oil and energy prices go down, and that's really anchoring and pulling down the overall inflation number, right? So oil again trading back in the low to mid 60s, and that again is historically, at least over the last 5 to 10 years, years relatively low, and that's keeping pressure on inflation.
So how do you think the market is responding to all this? In fact, what is it responding to? Like I alluded to earlier in the introduction, the S&P is up to 6,000 points now. It's nearing new all-time highs. Gareth, why this bullish sentiment?
Yeah, so I think the key here is that we've had these investors and retail, and even to some extent now, these second grade hedge funds that have really been saying, "Oh my goodness, I've got to pile in this market." And so I think the retail investor has really done well here because they've been the ones that have been targeted by the Fed and the government when the government and the Fed has come out and stimulated, right? So they're used to, and they've been programmed since the lows in March 2020 and every subsequent major sell-off that there's a V bottom recovery. So if you've been programmed to assume that that will happen, you're going to assume that in this situation it's going to happen again. And it's almost like a self-fulfilling prophecy, right? We're seeing the S&P, this beautiful down move, but then vertical right back up. And hedge funds have now been late to the party. They were sitting in cash. Now they're being forced to chase this into quarter end. We all know the quarter ends the end of this month, and they have to show that their investors that they did well during this recovery period. So I think this combination is driving markets up, but I don't buy that it's going to last here, and I'm going to show you why. So again, remember, I am a chartist, meaning that the charts are what speak to me. I translate it into probabilities. Now, one of my big concerns here is that if we go to that logarithmic chart on the S&P 500, we're still bubbling up against a trend line that goes back to 1929 before the major Great Depression market collapse. And then that same trend line connected to the high of the dot-com era. We just tagged it here. We pulled back. We obviously had a 20%, nearly 20% drop. Now we're pushing back up. So could the markets hit a new all-time high? Absolutely, they could. But this trend line, I have to respect it and understand that every time we've hit it, we've had a major pullback, whether it was the Great Depression, the dot-com collapse, or even this recent drop of 20%. And so again, if the S&P goes up to, let's say, 62 and a quarter to 6,250, I would think that at that point, the markets will see a drawdown. And let's be clear here, folks. The economy is slowing. Yes, the headline labor numbers, okay, sure. Whether you believe it or not, or whether you think that they're going to be revised down or not, we are seeing a slowdown in the global economy and the domestic economy. And at some point, these valuations of these stocks, which are historically very, very expensive, will have to come back to earth. And the charts here are telling us, sure, a little bit more upside, but then watch out for the next flush to the downside.
Your personal information is probably online right now. Your full name, home address, and phone number sitting on data broker websites that anybody can access or buy. It's uncomfortable, but also avoidable. That's why I use today's sponsor, Delete Me. They remove your private information from hundreds of data broker sites, so it's not just floating out there for anyone to grab. Getting started is simple. Submit your info, and within a week, you'll get a privacy report showing exactly where your data was found and what was removed. Delete Me doesn't stop there, and it continues scanning and deleting your data throughout the year. I trust this tool. It's helped me keep control of something that's easy to lose track of, my personal information. Go to joindeleteme.com/DavidLin, link down below, or scan the QR code here and use the promo code DavidLin at checkout. Get 20% off of all U.S. plans. Today, join Delete Me and take back control of your privacy now.
Gareth, at what point do you think that the S&P is going to start reversing? Obviously, we don't know the top, we don't know the bottom, but at what level would you start looking at it and say, this is getting way too frothy?
Yeah, so I think we're getting close to that. We're seeing today the semiconductors, and I want to show you actually this chart in a second, but the semiconductors are nearing a major resistance level. I also think there's a tendency to always get the maximum amount of bulls on board before the rug essentially gets pulled underneath the retail investor. And so when you look at the S&P, right, and we go back to our regular chart here and we look at where we are now only approximately, let's see here, we are about 2.3% away from our all-time highs. And so what would make investors the most bullish? Where would the shorts start to panic and stop out? Well, if we broke the all-time high, where would the people that are sitting on the sidelines that aren't really believing this rally, where would they finally throw in the towel and jump on the long side of this market if we broke the all-time high? So I think it's very plausible that we could come up to double top here, pierce double top, which would then have us hitting that longer term trend line at around 62.25 on the S&P 500 logarithmic chart, right? Going back right to here to this chart, right up here, we take out that all-time high, gets everyone bullish, thinking this market is unstoppable. We hit that line, and then it starts to come in. And I just want to show this chart too, one of my favorites on the NASDAQ. Look at this right here. So this is the perfect parallel channel. And channels, again, they tend to keep price between them. But you can use the trend lines of a channel to trade very accurately, i.e. the low of COVID all the way to the high of the bull market, back to the low of the bear market, then gave us our exact 2024 market high. We then had this collapse. Now we're pushing back up. So if the NASDAQ gets to about 21,000 or 20,900, we'll slam into that level again. And my guess is then you'll see that next big fall.
Can you just maybe pull up a NASDAQ chart and show us maybe a Fibonacci extension or maybe some moving averages and just maybe illustrate to us how overstretched it may be?
Yeah, so here's
you see, I'm starting to learn the technicals.
I know, I love it. I love it. This is awesome stuff. So here we have on the chart of the NASDAQ.
By the way, you're still showing the semiconductor chart. Can you?
Oh, I apologize here. Bear with me. All right. So let me bring up that chart here. Let's take a look at this. Here's your NASDAQ chart. Okay. So here we have the NASDAQ, right? And what we see here is this is that big parallel that I was just discussing. So let me show you this, and then we're going to look at these key Fibonacci retraces. So you have your COVID low to your bull market high. You have your bear market low that gave us our bull market high here in 2024, where we collapsed off of. We've now retraced. And if we get up to this level here, you would assume a rejection. Whether or not it gets up there is kind of up for debate. And if we go and zoom in on this, we can clearly see that if we take that previous all-time high and we do our Fibonacci retrace, we're right at the 886 Fibonacci retrace resistance. So you have resistance here. Then you have your all-time high right here. You're testing your double top. And then if we get through that, there's, again, upside to maybe that upper parallel. And I just want to show you this, too, because I think, we're talking about maybe a little bit more upside in the markets. But even if we go to that upper band of the parallel, that's only 6.7% higher. So again, the upside is very, very limited to me in this market versus the downside. I still think that at some point, the bottom is going to fall out of this market and we will see a major drop. And again, just flipping back to the SMH short term, I want to show you this. Take a look at this chart. So there's a trend line here. And can you see the SMH chart there, David?
Yeah.
Okay.
Got it.
So you have your all-time high on the semis right here, and you connect it to this high. And you have a gap fill right here. Notice these two lines are right in this zone. And look at what the SMH just kissed today, the lower band of that trend line. So huge resistance on the semis here. And sure enough, we're starting to pull back intraday on the SMH. It is coming in. And these are all signals to me that the market is running out of energy. The question is, when are the economic data points going to weaken? And that's when you'll see the bigger rollover. You'll see small pullbacks here, as long as the economy stays strong. But it's when those economic data points weaken, which they will, that's when this market goes down 10, 20, 30%.
Let me just take a step back and ask you a bigger question here, which is why we necessarily need to have a pullback now. I mean, some economists I've spoken to, not all, a lot of people agree with you, but some economists think that a recession is not going to be in the works anymore. And this is just a repeat of 2018 when Trump was in office. Then we had a bit of a pullback for tariffs, but then a V-shaped recovery ensued. So why necessarily do we...
why is this time different, for instance?
Yeah, why is this time different, basically?
So I think the key is you have to just look at the facts, right? So what's different about this time? So number one, we have tariffs. And even if they do these trade deals, remember, there's a baseline tariff for everyone at minimum of 10%. And even with this kind of truce with China, it's still 30. I believe it's 30%, if not 40%, that the U.S. has still imposed. So there is going to be tariffs, and there will be as long as Trump is president. The question is, at what level? In addition, what about government spending? right? So we've already seen Doge do their cuts. Now, granted, this big, beautiful bill doesn't really do much, but there are going to be cuts in that bill. In the very least, the spending won't be as maximized as what we've seen prior in previous bills from the government. The deficit essentially probably rises a little bit less, or the debt rises a little bit less than it has been, albeit probably still going higher. So there's this issue now where the government is being much more aware of spending, where they're not just going to flood the market with liquidity. And the Fed is very clearly not quite as aggressively cutting rates at this point. And so what that does is the stimulus from those factors is now missing from the core situation in the economy. And I think that one of the keys too is that we're starting to see the consumer react. Consumer spending is starting to crater a little bit. We're seeing people be much more careful about where they're spending their money. The airlines are saying people are traveling less. That big, huge travel, massive move from COVID has now expired, and people are back to normalized living and being more careful about spending. And we know the consumer is the driving force of the economy. So I think all of these factors are going to lead to a slower economy this time, where stocks will actually have a longer term down move.
Is there a particular trigger that you think will be the catalyst for this down move?
Yeah.
Besides tariffs.
Yeah, so the essence of it is it's going to be when the labor market fully cracks. And again, there's already cracks in the labor market. Let's be crystal clear. Last week, jobless claims jumped up to 247. The previous week was 239. If you look at jobless claims the previous month or two, it was hovering around 220. So jobless claims, which are people filing for unemployment, it's ratcheting up almost on a weekly basis now. That's a sign right there. Then you look at participation rate. Remember, participation rate, when it declines, it tells you people are saying, you know what? I've been looking for a job and I just can't find one, so I'm going to take myself out of the potential workforce. That is a bearish sign for the labor market as well. So the cracks are there. You just have not seen the glass shatter yet. And that's what I think will be the trigger towards this market decline.
Okay. How do you think the Fed will respond to this glass shattering?
Yeah, so I think, and this is going to be really interesting. So as long as we don't see this uptick on inflation, the Fed will eventually start to be aggressive, thinking that they're behind the curve in terms of cutting. I think right now they're pricing in 2 rate cuts the remainder of the year. I wouldn't be surprised if we have 3 by year end, but I still think overall they will cut as long as the tariffs don't trigger an uptick in inflation. And I think that's the one wild card that a lot of investors are now saying, oh, don't worry, the Fed can cut rates so we can continue to buy the market. Well, again, let's keep an eye on those inflation numbers, which, remember, the inventories that have been built up will keep inflation low for a period of time. Eventually, if those tariffs stick, the higher prices will come.
When the Fed eventually does cut, either aggressively or conservatively, do you think the stock markets will move in response, meaning move up?
So interestingly enough, history has shown us that initially the markets do react positively. They say, oh, thank goodness. But then the markets actually have a tendency to sell off as the Fed is cutting rates. And the reason why they sell off during rate cuts is because the markets are worried that the Fed is behind the curve. Historically, the Fed has, whether it was on the upside when inflation was bubbling up and they said it was transitory, or on the downside when the economy is slowing, they tend to be lagging in terms of how fast they should cut. So generally, historically shown, we see that the Fed, when they cut rates, the markets tend to actually continue to sell off, getting very concerned about how deep the economy is going to go into recession.
Okay, well, let's turn the page now to look at some other assets, Bitcoin in particular. Well, Bitcoin, if you overlay that with the S&P 500 or the NASDAQ, again, over the last couple months, if you just look at it from a multi-month horizon, they do look very much correlated to each other. So do you have the same analysis for Bitcoin as you did for the NASDAQ?
Yeah, I do. In fact, almost identical. And you're right. You know, there are periods with Bitcoin where it diverges slightly. And for instance, when there was this fear in early April that the treasuries were not demanded by other countries, countries were fighting back saying, hey, we're not going to buy U.S. debt. We saw that uptick in yields. The market obviously panicked, but Bitcoin started to see some interest there. Same thing with the dollar, where the dollar has historically been the safe haven asset. But for short periods, people were like, wait a minute, maybe the dollar's not the best safe haven. Maybe we should buy some Bitcoin. But aside from those rare instances, the market has led Bitcoin up and down. And we could see that very clearly. Like last week when Elon Musk and Trump were having their feud and the stock market sold off, we saw Bitcoin selling off. Then as the stock market has rallied back up, Bitcoin has rallied up as well. But having said that, you have to look at this chart right here. And I'm going to just zoom out on this one chart on Bitcoin. And I want to show you this trend line. And this is the trend line that has me thinking that Bitcoin, while it could go a little higher, is capped in the near term. Look at this trend line, guys. This is a parallel. And again, what we can see on this parallel is that you have your exact low here and here. And then if we flip over and look at the highs, the 2017 bull market high, the first high in 2021, the second high in 2021, and then here in 2024, early 2025, look at that high right up into that parallel. So what that tells me is that if we see Bitcoin rallying up, it's going to have a lot of resistance right here, and it's going to likely get rejected again and come back in. And that matches generally the thesis that the NASDAQ, the S&P might have a little bit more upside here, maybe to new all-time highs. In this case, Bitcoin could hit a new all-time high, but then be very careful of that big pullback that we have clearly seen. Here, the bear market. Here, the bear market. Does that institute another bear market on Bitcoin? If the NASDAQ goes into one, most likely.
Interesting. Same question I have for Bitcoin as I did for the NASDAQ and the S&P 500. At any point, would you say it's time for a reversal? In other words, what are the levels for the floor and the ceiling?
Yeah, so ceiling is going to be, at least based on this chart, around 115. So you got a ceiling of around 115. And then you would be basically, for me at least as a technician, if we ever get back to this lower band of the parallel, that would be where I would be a buyer, which is down around 55 to 60,000. And obviously people will freak out when I say that. But remember, historically, Bitcoin pulling back, this would be about a 50% pullback. It's actually not that unusual to see that type of pullback. In addition, if we look at the chart here, look at this. That level coexists right with this area of support that Bitcoin was at just back in July of 2024, basically 1 year ago. And so it would be a good retrace hitting two major supports, and then you would have to think that Bitcoin would be a buy. And I just want to be clear, I'm a shorter term investor and trader. I'm a big fan of Bitcoin over the longer term. But again, being a chartist, I have to let the charts tell me where resistance is and where support is.
If you just look at the chart that you have on the screen here, mid 2024, Bitcoin had a bit of a pullback. Were you surprised that the pullback was not as big as it could have been? In other words, I think it went down from 71 to about 57. So that was less than a 50% retracement. Were you surprised by that move?
Not really, only because the stock market was still in a bull mode, right? We still were seeing that was, by the way, that pullback in Bitcoin coexisted with our July into early August stock market drop where it was panic there for a very short period of time. But what we know is that the stock market then ripped higher to new all-time highs, and that's exactly what Bitcoin did. And in fact, what this is called here, the beauty of this chart pattern, just for a little education, this is what we would call a bull flag, right? So you have a big up move, there's your flagpole right here, and here's your bull flag. That was telling us another move was going to come up, and that's exactly what it did until we tagged the high end of the parallel.
Interesting. Now, let's say Bitcoin breaches above your ceiling, so above 117,000, 115,000. What would you do then? Would that be an overbought signal, or would that be a bull market signal?
So if it, and first of all, you're exactly right. A good trader always understands that any level of resistance that they have could be broken, just like any support level that they have. So if we were to break above it, I would watch it carefully, because sometimes what the charts do and the institutions do is they'll push things above a little bit just to try to stop out the weak hands on the short side and get more bulls on board before reversing it. And so I'd watch very closely to see if it confirms above that level. And if it does, then you got to think that we're probably headed towards that 150 zone, which would be your next resistance point. But again, right now, as long as that level is there, meaning the 115 level, I respect it until proven otherwise.
So you say you're long-term bullish on Bitcoin. Somebody listening to our conversation right now might think, well, you're saying it's almost at a resistance point, but you're still long-term bullish. It has the ability or the potential to retrace 50%, which is not unusual for Bitcoin. I mean, what should I do at this point? Do I stay long and ride out the waves, or do I start shorting?
Yeah, so I think the first question everyone has to ask themselves is what's their time horizon? If your time horizon is you're a short-term investor, I would be in cash or short Bitcoin. I'm short Bitcoin myself right now with a stop just above that 115 level. If you're a longer-term investor, who cares, right? I mean, if your outlook is 20 years, just basically dollar cost average. If it comes down to 80, buy a little 70, 60, 50, etc. And I think that's the key. So time frame here does matter in terms of how you are as an investor. Shorter-term investors need to be aware of the down move. Longer term investors, this is just another blip on the screen in a general uptrend that we've been in since really the beginning of Bitcoin.
Gareth, let's take a look at gold now. Another asset class that has been moving significantly. It's been consolidating around the $3,300 an ounce range. And I think people are wondering whether or not this consolidating pattern is going to result in a breakup or breakdown. What do you think?
So as of now, it's bullish consolidation. There's no doubt about it. Right now, you have this longer term trend line down here that goes back to December of 2024. It kind of started there around 2,500, took us all the way to 3,500. Notice that the move from here just about 3,000 to 3,500 was very steep. Those type of vertical moves that come at the end of longer term uptrends, those need digestion. And digestion is a term that means consolidation. It needs to digest the big move up. And so that's what we've been doing here. And what you can see here is you have a trend line that connects that 3,500 high to this secondary high here and this third high. Notice we've been consolidating in there, and then recently we went above, and now we're staying above that line. As long as this line holds, the bias is very bullish. If we get back in this zone, it's more of a neutral to bullish. And then if we broke below 3150, then you want to be a little bit concerned on gold. So again, as of now, strong bullish bias here with upside easily to $4,000, maybe $5,000 over the next year or two. Just watch your levels. As a trader, for me, the 3140, 3150 level is a line that sticks out. I want to see the trend. Basically, the trend needs to hold there.
If I were to allocate more of my assets to overweight one position, would it be Bitcoin, stocks, or gold right now?
I would say right now it would be gold with a spattering of platinum, palladium, and silver. But I know that wasn't part of the question. But again, those haven't run as much as gold, so I actually like them, and they've started to play catch up a little bit here in the near term. Bitcoin, because it's a risk asset with stocks, I classify it as one of those, meaning that if I think the stock market's going to pull back, Bitcoin likely will as well. Longer term, if you ask me over the next 10 or 15 years, Bitcoin would be the answer. But shorter term, 3 to 6 months, I would be still long gold.
Actually, let's take a look at silver, since you brought up silver. Huge move in the last 2 weeks, dramatically outperforming gold. What's going on right now? Is there a particular silver story that we need to address, or is this just finally starting to catch up to gold?
Yeah, I think it's more the catch-up trade. The silver-gold ratio has been very, very low historically. We've seen this with platinum and palladium as well. They're starting to play catch-up. They're both rare. Platinum and palladium are even rarer than gold, yet they were, priced 1/3 of the price of gold. Silver obviously isn't as rare, but it's basically the poor man's gold, meaning that it's going to play catch-up with gold here. I do think, again, you're probably seeing a little bit of a short squeeze in general. Upside, I have this pivot that I'm watching very closely at around 37.50 for a short-term pullback. And then if it breaks through there, we probably go to that $50 level, which historically has kind of been your topping point, right? $48 to $50 right up here. We can see that was your high back in the 1980. And then we briefly pierced it right here in 2011. I think eventually we go up and retest that level.
Interesting. Do you think then that silver is going to be an outperformer relative to gold for the next couple of months?
I do. I actually do. Yeah, I do. And granted, it's already done quite a bit. I mean, percentage-wise, silver's had a massive move in just the last week or so, going from below 33 to now 36. So that's 10% right there. But I do think there's more fuel in the tank here for silver, as well as some of these others. Just to show you quickly the palladium chart here, which is a pretty remarkable chart. You can see here, I mean, zooming out, look at how low palladium was And if you look at gold, gold's trading up here, $3,300, right? But look at how palladium is been grinding lower, yet palladium is about 30 times rarer than gold, as is platinum, right? So granted, they're more industrial metals, which is why it's been lagging. But for me, as someone who wants to diversify away from fiat as much as possible, something about rarity does matter, right? Rarity does matter. And then if we zoom in, look at this, hits here, pulls back, hits, pulls back, hits, pulls back, breaks out, retraces to the scene of the crime, which is the classic setup. This is your buy right here, and then boom, to the upside this go. So I could easily see, palladium and platinum north of 1,500 in the not too distant future.
Wow. Okay. Do these signal economic recovery for you, or is this just an independent move from the underlying fundamentals of the economy? Because we talk about Dr. Copper being a signal. I wonder if palladium and platinum have the same kind of effect.
Yeah, so to me, this move is not so much related to industrial, production or the economy. It's more of a where is gold? Gold has run X amount. What hasn't run that is still a rare metal? And that's where these other metals are playing catch up. And this is something we see in the stock market, right? You'll see Nvidia make a big run, and then all of a sudden the other semiconductors are like, oh, Nvidia's running, we got to play catch up. And they'll run after it, right? So I think that's more of what this is. It's investors chasing, but that certainly gives us an opportunity here to play that catch-up trade, and it's working so far on these other metals.
All right, let's take a look at the 10-year yield now. If you can pull up a 10-year yield chart, Gareth. Again, extraordinary moves over the last 2 months, right? A lot of volatility, and now we're back approaching 5%, not quite yet, but approaching that level. Will you be a buyer or a shorter of bonds right now at the current level?
So I would be a buyer of bonds, meaning I think yields are going to go lower. And just to show you the chart here, we have this nice wedge pattern where you're basically connecting this low back from April. So this was the low in April before we saw that big spike. We then came down again, we pushed up, and notice right here what has happened. We've broken below this trend line, consolidated, broke down, and now retraced to what we call, again, the scene of the crime. We just talked about it on that palladium chart. And what it tends to happen when you do this is resistance, and it's going to reject price, and price is going to fall. And in this case, it's the 10-year yield. And so what this tells me, and interestingly enough, you can extrapolate that if the yields are going to fall, it tells us that the U.S. economy is likely going to weaken further, which again means more rate cuts potentially. And that again is the direction. So I'm looking at being short on yields, but that would mean buying bonds.
Generally speaking, then, your favorite and least favorite asset classes for the remainder of the year?
So for the remainder of the year, I'm looking at foreign stocks. Foreign stocks are where I think it's at. One of my favorites is Brazil. We've talked about this one in the past. This one, again, has been in a long downtrend. It's not been loved while we've seen U.S. equities soak up most of the investment money. This, again, has a beautiful kind of wedge pattern formation here. We can see right here, I'm expecting a breakout on this Brazil ETF. I also think China does come with risks, obviously, but compared to U.S. equities, these charts are so beaten down that I think there is light. And what I'm seeing is that Trump really does want to make a deal with China. He wants to ultimately try to avoid the pressure of all of these tariffs on the U.S. economy. Granted, I still think there'll be a certain level of tariff, but I think that as long as things get good here, the Chinese stocks are near a major breakout. This is Baidu's chart, for instance, long-term trend line. I'm watching for a breakout above $90 on this one, and Alibaba has already broken out. If we look at this chart here, you could see classic breakdown. Look at that. Hits, breaks out, and then here's your retrace to the scene of the crime. And I think this chart is going to go a lot higher. So I'd be looking more so now at the unloved external U.S. Companies or stocks, and then looking for money to rotate out of the U.S. into those unloved names and bring them back up.
Are you not concerned about trade war uncertainty with China still?
I am. So, I mean, for me, I have to limit my exposure, right? So the way we deal with risk is we say, okay, well, I might have done 15 or 20% of my portfolio in these companies, but instead maybe I'll do 10 or 5%. So you absolutely have to take that into account with China. There's always that risk, at least in these current times. So I do think that's important to bring to the attention. Yep.
Okay, good. Well, thank you very much, Gareth. Let's now talk about you and your work. You have a very interesting event coming up. I think it's called Investor Empowerment Day. Tell us about that.
Yeah, so here at Verified Investing, it's our second annual Investor Empowerment Day, and essentially it's a time where all year long I teach, I show people how to look at charts, to be objective, not rely on the hype of social media or the narratives of the mainstream media. So I think that's really the essence of it, is where this Investor Empowerment Day is about empowering retail investors to say, all right, don't rely on what you're hearing out there on social media. Look at these charts, look at the facts, look at the probabilities to make decisions. Step your game up to basically compete and beat the institutions. And really, that's what it's all about. So I'll be live trading on Investor Empowerment Day. My traders will be talking about charts. We'll be educating. It's going to be awesome.
All right, excellent. We'll look forward to that. Gareth, we'll put the link down below. Follow Verified Investing down there. So we'll see you soon. Gareth, thank you for coming on the show and educating us today. Cheers.
Thank you so much, David. Take care.
Yeah, always good to see you, and always good to have you, the audience, join us on the program. Don't forget to like and subscribe. Follow Gareth, the link down below.